Hello, everyone, and welcome today. Thanks so much for joining us. My name is Alex Levatov. I'm an Associate Managing Director here at K2 Integrity. I'm going to be joined by a couple of esteemed panelists I'll introduce in just a moment. And our topic for the day is opportunities, risks, and compliance in the digital asset space. As you can see on the notes on the screen, there's a Q&A box where you can ask questions throughout the session, and we'll leave some time for Q&A at the end. And there will be a few polling questions throughout that we invite you to respond to in real time. You can email Brooke with any technical to go along. Today, I'm joined by K2 board member and Georgetown University law professor Chris Brummer, as well as Senior Managing Director at K2 Integrity, Mariano Federici. Again, my name is Alex Levatov, and we look forward to the conversation today on digital assets. So just a brief overview of our agenda. We're going to start with just some basics on what are digital assets, some of their use cases and applications, and then moving into some of their potential disadvantages and risks with a focus there on illicit financing, threats, and vulnerabilities related to digital assets. We'll provide an overview of international standard setters as well as international standards for a key player in the digital asset ecosystem, virtual asset service providers, or VASPs. So to start things off, we'd like to begin with a polling question just to gauge the group's experience and exposure to digital assets. If you could just take a moment to respond to the survey, we'd be interested in understanding if you have extensive, deep knowledge of digital assets and closely monitor regulatory developments, or if you describe your exposure as moderate, low, or if this is just a new topic for you. So I'll give everyone a minute to respond to this question, and then we'll be able to see the results after that.
I suppose this is going to be part of the process to make sure, are the awareness whether or not the day traders or the lawyers will have more or less information than the students or the professionals at the large banks. But these kinds of questions are always interesting.
There we go. I think you should see the right polling question. So let's take a minute just to provide your level of exposure to digital assets and see where we're all starting out as a group.
Alex, are you muted?
Thanks, Chris. Appreciate that. So great. Before we move on, we've now received the polling responses, and a majority have answered that they have, or most participants have answered that they have low or basic working knowledge of digital assets. So this is a great place to start with some exposure, but still a lot to learn. So I think that's that's a great place for all of us to be moving on to, and we'll then go right into our overview. So I know that a few did respond that they had no exposure to digital assets before this session. So just as a basic level setting primer, digital assets can be defined as digital representations of value, financial assets, financial instruments, or claims that are issued or represented in digital form through the use of distributed ledger technology or blockchain technology. Digital assets can be used to make payments, to make investments, or to transmit or exchange funds or other forms of value. This is a type of value that can be traded across multiple types of platforms, including both centralized and decentralized finance platforms, or through peer-to-peer technologies. So this is a very broad and encompassing definition of digital assets. It's adapted, as you can see on the right, from the President's Executive Order on Ensuring Responsible Development of Digital Assets from March of this year. And if we go into the next slide, we can see that this definition of digital assets encompasses a very wide range of types of value, including native cryptocurrencies that you may be familiar with, like Bitcoin and Ether, as well as stablecoins. And stablecoins themselves can be broken up into two types. You have reserve-backed stablecoins like Tether or USDC, as well as algorithmic stablecoins like DAI, as well as Terra USD that you may have heard of from having crashed in a pretty momentous event back in May of this year. Digital assets in this broad sense also include central bank digital currencies, which are a form of digital money that's a direct liability of a jurisdiction's central bank rather than being a liability of a commercial bank. Central bank digital currencies are a big emerging topic that are currently being developed, explored, or piloted in a number of jurisdictions. We've seen 10 countries that have fully launched a CBDC, but China's pilot has been very high profile and is set to expand next year. In addition to CBDCs, we also have non-fungible tokens, which are digital units or tokens on a blockchain that represent ownership of images, video, audio files, other forms of media, and can also represent ownership of physical or digital property. NFTs are usually unique rather than interchangeable. And at least at this moment in the evolution of the industry, they're typically used as collectibles rather than as payment or investment instruments, although there are some investment use cases of NFTs that have emerged. And then finally, the broad definition of digital assets includes tokenized representations of traditional financial assets, such as securities, commodities, and derivatives.
Yeah, I think just for that 7% of the folks who said they have never seen this before, when you think about it, what they all have in common is that they're operating on top of a blockchain, right? And that's a kind of a database or decentralized database that can operate in all kinds of different ways. The one that most people immediately think about is through a kind of a ledger function, right? And so instead of think back to medieval Renaissance Italy or something, where you had the guy with the feather who was writing transactions in and out of a bank. Here, an individual who controlled a certain book that not everybody could view. Here you have a decentralized sort of network of computers with usually a large degree of transparency as to what's being written, what's being memorialized, and that underlying technology, and there are lots of different aspects to that technology, is being explored, and you have different kinds of virtual assets that leverage that technology and that either run on top of that technology, or that technology is used to memorialize ownership of a particular digital asset.
Thanks, Chris. And exactly on that point, this new technology provides a number of potential advantages that are being explored and utilized in this space right now. And so just to give a very quick overview of some of those potential advantages are faster payments. So many of us have worked in traditional financial institutions or with traditional financial institutions and know that it can take days sometimes to clear payments through the traditional financial system, particularly when those payments are going cross-border and require the involvement of a number of intermediaries. Digital assets can be transmitted at the speed of the internet, and this is one of the major sort of attractions of that technology as a means of payment. Similarly, digital assets can increase access to previously illiquid assets. So you can own a small fraction of a home that's has ownership rights registered on the blockchain, and that while fractionalization of illiquid access is something that has been done in traditional financial practice for some time, this technology brings those fractionalized assets to a much broader set of potential retail investors and consumers. And so this is another important promise of the technology. Digital assets provide high security and privacy assurances, as well as what Chris mentioned just a minute ago, increased transparency through a shared and immutable record on that distributed ledger. Digital assets can be transmitted at reduced transaction costs. Again, as you imagine the shift away from multiple intermediaries throughout a cross-border transaction chain to potentially near instantaneous peer-to-peer transactions. We can also note in the same vein reduced barriers to entry for new participants into the space. And sort of bringing a lot of these potential advantages together, digital assets promise to bring more people into the financial system and create greater inclusivity and access to different types of financial instruments that may have not been available as widely and on a truly global basis. And then finally, there's some political interest in the digital asset space as a form potentially of circumventing capital controls or forms of financial surveillance that have been imposed by authoritarian regimes or other other government actors, so that you can access, again, financial assets and instruments going around those government controls. So to go to the next slide, just to highlight three potential applications of these advantages. One is in sending cross-border remittances, which can currently be a very costly sort of way of transmitting value across borders, and requires the person on the receiving end to have access to sort of formal institutions to receive the transmission of that value. But digital assets could potentially be used for remittances in a much faster, cheaper way that goes directly to anybody who has access to an internet connection. Similarly, digital assets have been used to provide greater access to stable dollar-like assets in particular contexts that may be suffering currency devaluations, high rates of inflation, and so on. So it's another potential application where we've seen a lot of interest in stablecoins in countries like Argentina and Turkey that have high rates of inflation, but where direct access to dollars can be difficult and has typically created black markets for that currency. And then finally, reaching crisis zones for charitable giving. We've seen just in the past year applications of charitable giving via digital assets to Afghanistan and to Ukraine following Russia's invasion. So with that as a primer, we're going to do one more polling question. So again, this is one with no right answer, but just to gauge the sort of views of those here at this webinar today. So which feature of digital assets is most appealing to you, whether you're operating a business or working as a consumer in some other capacity? Is it faster payments, lower fees, enhanced privacy, or the decentralization of money? So give folks a minute to answer this question before we move on.
Yeah, I think that, as people sort of think about those issues, I think it's useful just to understand that many of these issues or advantages, when we develop the slides, we want to have a rolling start into, okay, why are people excited about this before we jump into sort of the darker side. But even these are all sort of testable hypotheses that we'll see sort of examined in the very near future. But the basic idea is pretty simple with each of them, that if you want to send money in the United States from one bank to the other, just given interbank relationships or even credit cards, it can either take a long time or there can be embedded fees. And different people have interests in varying aspects of sort of blockchain technology when it comes to helping to facilitate certain kinds of financial transactions. When it comes to the financial inclusion question, then there are questions as to whether or not you can either make it less expensive to receive money if you're living paycheck to paycheck. Are there means to send money overseas for remittances, as we saw? These are all the kinds of questions that people are trying to explore right now. And there are varying degrees of sort of certainty as to the ability for the newer technologies to deliver that now versus in the future. But there are already some very clear steps in the direction. There are just questions as to how far they will go. But it is attracting an enormous amount of interest, and so we thought it'd be interesting to figure out from the audience. Well, of these different advantages, you can disaggregate each one of them, and you can very well be more interested in one aspect than the other. And maybe it's good to get a little sense from the audience when we talk about the slides, what that element may be.
Terrific. So it looks like we've got some poll results in already. From your responses, faster payments and lower fees both came to the top of the list as the features that are most appealing to you, followed by decentralization of money, and then enhanced privacy, interestingly, coming in at last. So that's an interesting data point to frame the discussion going forward, as there are maybe some trade-offs between the privacy benefits of digital assets and some of the illicit finance risks that we're about to talk about. So thanks for your responses. Chris, would you want to maybe set the stage with just teeing up some of the broader regulatory and risk management issues here?
Yeah, so likely if you're attending this webinar, you've been watching the news and you see all kinds of regulatory announcements or finger wagging or enforcement actions when it comes to the crypto asset space, along with obviously large inflows of capital and lots of interest by financial institutions and entrepreneurs and startups. On the regulatory side, the range of potential sort of pressure points are considerable, in part because sort of registration and licensing questions kind of arise. This in and of itself can be disaggregated into whether or not the digital asset that's being created is part of an investment scheme that under Section 5 of the 33 Act would be considered to be a security. So for the lawyers watching and who have passed securities law or who have forgotten their securities law and have chosen not to remember it, you'll recall the Howey test, which really tries to define when you have an investment of money in a common enterprise and you're relying on other people to make money. Securities law largely says that several kinds of disclosures need to be made, and a process needs to be instituted for registering that asset with the SEC. The challenge there is that is an ad hoc test, and if there's a disagreement, it's usually litigated. There are no bright line rules. So one of the larger conversations in the space is, well, when is a digital asset a security? And then what should that sort of registering and licensing process look like given the particularities of a digital asset? Um, likewise, digital assets are pretty vague and they can be highly technical. And so some of the consumer protection advocates are really interested in whether or not there's some kind of abusive relationship with either consumers, and that consumer protection question sometimes dovetails with the larger investor protection question of disclosures, although not always the case, but often. Um, when you talk about, like, sort of just as a simple example, why this particular asset doesn't necessarily map neatly onto existing regulatory frameworks and paradigms, and we'll see this a little bit in just a second when we jump to illicit finance, just take the basic question of disclosure. If you're going to do an initial public offering of the Ford Motor Company, back in the 1920s, you may ask yourself, well, what's important to know about that IPO or something? You'll say, well, I'll need to know the management and the board of directors and the financial statements maybe over the last couple of years as the company is trying to scale. But in this sort of technology, those aren't really the most important things. You don't need to know so much about corporate governance. You need to know about blockchain governance. Like, what are the things that inform how the blockchain operates? You're not so much concerned with the financial statements because lots of these companies are very, very young. Instead, you may be more concerned with the technology that's being used, and you're more interested in an audit, not so much of the financial statements, but maybe an audit of the tech, right? So there are all these kinds of new questions that arise throughout the financial ecosystem, just given the particularities of digital assets. And then obviously, when you move to the illicit finance space, all kinds of questions are raised in terms of anti-money laundering, combating the financing of terrorism and the proliferation of weapons of mass destruction, countering sanctions, and each of these issue items as well kind of push on the boundaries of how we have traditionally conducted surveillance, the kinds of assumptions one makes about the identity of individuals and the accessibility of information and the transactions in which they are engaged in. And so there is a mountain of regulatory energy and interest in this space that people like Mariano and Alex are jumping headfirst into. So actually, with that, I'm going to pass the mic to my friend Mariano. And you have to be unmuted.
Go. So, as you were saying, Chris, of course, there are certainly huge opportunities in the digital asset space. We looked at some already and got the feel also for from the audience from the polling questions. But there are certainly risks as well. It is estimated that cyber criminals may have laundered approximately $10 billion worth in digital assets in the past year, in 2021, and over 30 billion since 2017. Complexity issues that make vulnerable anonymity and pseudo-anonymity aspects as well. The decentralization of the technology, decentralization of money is also another characteristic. Their irreversibility. There's certainly high transaction values and throughput and weak regulatory architecture still, even though there has been a call by international organizations to regulate digital assets across the world. Number of countries, number of jurisdictions that have moved forward with developing regulatory frameworks is still low, and this offers a huge opportunity for arbitrage and abuse as well. And certainly there are cultural issues as well in the industry that's not yet developed high standards of compliance culture in general. There's immature and risk and compliance programs in many of the companies that make up the industry as the culture develops, which offer a certain degree of maturity of compliance programs and risk management practices is much more developed. Next slide. Chris, I think this goes back to you.
So, okay. So, and by the way, there was a little bit of, I can't tell if it was on my end or on your end, but there was a little bit of interference, Mariano, on that last slide. Next time I'm going to jump in to interrupt you, but I can't tell nonetheless, because reception isn't always great, even here in our nation's capital, here in DC. So, okay, so how exactly then do criminal actors exploit these kinds of vulnerabilities, right? And again, I want to sort of highlight certain aspects of crypto assets and digital assets. You know, it may not necessarily, these features may not necessarily make them unique, but it does allow for a greater ability for individuals to sort of exploit, right? So, you know, when you get to something that's a little bit more abstract and certainly more technical, you know, it makes it easier to engage in different kinds of frauds and scams, especially given the amount of money that's coming into the sector. You know, greed and fear kind of motivate lots of investments, and both of those sentiments are very easily exploited by fraudsters looking to take advantage of people. You know, when you can operate on certain kinds of you know, well, I should take a step back. You can go and you have challenges with darknet marketplaces, hacks, theft, and other cyber risks, because many of your digital assets are being kept in a wallet. Even though the blockchain itself may be very secure, the way in which those digital assets are stored often depend on an individual and their own understanding and knowledge and sort of self-care. And people can sometimes be very easygoing when it comes to the protection of their private keys. That's the information that one needs, the string of numbers that one needs in order to access a wallet. You also have sanctions evasion, financing of terrorism, and WMDs, and these kinds of issues apply to different kinds of contexts, right? So you have certain kinds of state actors who are trying to build their own you know, crypto infrastructure for the purpose of evading sanctions. But then again, they may themselves be market participants in other kinds of infrastructures and to utilize certain kinds of tools that make it easier for them to evade detection. Now, at the same time, what's really interesting, and we'll get into this in a bit more, is that when you talk about the public blockchains, this ability to or this interest in some instances, evading sanctions runs against the reality that the transactions themselves that are taking place are, at least on a public blockchain, taking place in a very, very open environment, in a very, very transparent environment. So it's a sort of a give and take where there is interest in exploiting the pseudonymity that is available on many blockchains, but at the same time, there's an enormous amount of transparency as well. Even when it comes to frauds and scams, you can try to engage in certain kinds of fraudulent declarations about whether or not your technology works, although technically much of the code is already available on chain. It's just that you have to be rather sophisticated technologically to sort of kick the tires and to understand whether or not the declarations that are being made match what's visible and available to anyone on chain.
Great. So I could just the space could be exploited by criminals and other illicit actors. And so we wanted to ask, what do you think is the largest form of cryptocurrency-based crime by transaction volume? Would it be the darknet marketplace sales, stolen funds, scams, or financing of terrorism? So we give folks a minute to respond to this question. And while you're answering, since we don't have sanctions evasion up as an option for this question, I did want to just flag a detail from this past week. So many of you may have heard that so Russia's finance ministry and central bank have recently announced plans to legalize the use of virtual currencies in international trade, specifically in an effort to counteract the effect of sanctions against Russia. And so we haven't seen large scale sanctions evasion out of Russia due to just liquidity challenges in the digital asset space, but that is something that the government is actively pursuing as a potential lever of sanctions evasion at the moment. And then for the question that we have in front of us, it looks like we have results in, and looks like the leading response from the group was stolen funds, followed by scams. So in fact, the correct answer based on the best industry data we have from 2021 is scams as the correct answer. Scams accounted for about 55% of the cryptocurrency-based crime in the last calendar year. Scams here include Ponzi schemes, but also 2021 saw a huge uptick in a particular type of scam known as a rug pull, where developers create new tokens, promote them to investors, and then unexpectedly abandon the project and drain funds out of the project's liquidity pools. And so those two types of schemes have really contributed to a lot of the crypto-based crime in the past year. So about $7.7 billion worth of crypto crime of the $14 billion on record from 2021 owed to scams. So that's the right answer here.
And I think that's interesting because it also shows that, some of this stuff is new in terms of the challenges, like just given the particularities of the features of the technology, just as it enables all kinds of very interesting new opportunities. But then some of the stuff is just old school 19th century, 18th century. I want to sell you a bridge, in Brooklyn kind of stuff. It's just that the novelty may allow individuals to more easily, again, exploit novice investors or those who may be a little bit lazy in terms of doing their homework.
Terrific. And then, Chris, you want to sort of again maybe do a bit of scene setting on international standards in general, and then we'll drill down some more on the illicit finance side of things.
Yeah, so when we get to this part of the webinar where we're going to get into what the rules are, so to speak, and how the international community is dealing specifically with the problem of illicit finance, I like to kind of tell my students and other regulators who are trying to grapple with how to understand this, is that the international regulatory system is, interestingly enough, in its own way, decentralized. That there's not, one particular regulator that regulates every single aspect of the financial regulatory economy, but just like on a domestic level, you have different kinds of actors that specialize in different kinds of things. You have the same thing that happens internationally. And so you have the banking regulators who may meet, over at the Basel Committee, the securities regulators that meet over at IOSCO, the International Organization of Securities Commissions. You have something called the Financial Stability Board, which is kind of like the the United Federation of Planets, where you have all the different kinds of regulators who are kind of meeting together to hammer out rules. The FSB's primary original purpose was to find those kinds of issues that may slip through the cracks And so how do we address them? And obviously cryptocurrency is one of those issues that could easily be deemed to be one or more or neither of the interests or the mandates of any particular regulatory body. And then we have FATF, the Financial Action Task Force, which is the most relevant for our conversation today, the crime fighters.
Okay, we can move to the next one. So as Chris was just saying, the different risks and issues have been tackled by different global regulators. The illicit finance risk has largely been tackled by the FATF, the Financial Action Task Force. For those that don't know it, it's the standard setter, global standard setter on anti-money laundering, counter-terrorist financing, and other counter-illicit financing issues. The FATF also evaluates jurisdictions against sanctions. So it's a powerful organization.
Yeah, I think you're breaking up a little bit. So while you're breaking up, I'll just take over that second paragraph there. That the FATF has been forward-leaning in addressing illicit finance risks presented by digital assets and VAS.
Okay.
I think you're back.
Can you hear me there?
Yep, we can hear you now.
Yeah. Okay. Yeah. So the FATF started working on these issues in 2014 when it began formally addressing the topic through an initial paper that was in response to the emergence of virtual currencies and their associated payment mechanisms. As the context evolved, the FATF began getting more immersed into the matter. But it was not until 2018 that the global standards, the international standards, were amended. It was, in fact, in October 2018 when the FATF amended the Recommendation 15 with a focus on the definition of virtual assets and virtual asset service providers that we'll look at in a second. The amended standard basically required the intermediary, the virtual asset service providers, to be regulated for AML/CFT purposes, anti-money laundering, counter-terrorist financing purposes, licensed or registered, and subject to effective systems for monitoring or supervision. We'll look at that in more detail in a second. Also, some interpretative notes and guidance have been issued by the FATF, particularly on how to adapt the risk-based approach to virtual assets and virtual asset service providers. And we'll take a look at that as well. We can move to the next one. So what are virtual assets under the FATF standard? The definition of virtual assets under the standard is meant to be interpreted broadly, let's say. In line with other recommendations that the FATF has issued, they are aimed at being technology neutral, let's say. That is, they should be applied based on the basic characteristics of the asset or the service, and not the technology they employ. So there are a couple of elements that are worth examining in the definition that you see in the screen. We see that virtual assets must be digital and must themselves be digitally traded or transferred and be capable of being used for payment or investment purposes. Intentionally create a broad general definition of virtual assets that covers a pretty wide range of activities. This could include, for example, the issuance of an asset to another person, exchanging it for something else, transferring it to someone else or on behalf of someone else, and changing its ownership or even destroying it. We see there that the virtual assets cannot be merely digital representations of fiat currency, securities, or other financial assets that are already being covered elsewhere in the recommendations. For this reason, for instance, a bank record maintained in digital format for example, which represents a person's ownership of fiat currency, is not considered to be a virtual asset. If it functions as a mere declarative record of ownership or positions in a financial asset that is already covered by the global standards, it is therefore not considered to be a virtual asset. However, a digital asset that is exchangeable for another asset, such as a stable coin, as we touched on, that is exchangeable for fiat currency or for another virtual asset at a stable rate, could still qualify as a virtual asset. And national regulators may opt to adopt an alternative classification system, for instance, by categorizing virtual assets, securities, commodities, or bringing them under the existing regulatory framework if we can move to the next one, Brooke. So what is a VASP then, a virtual asset service provider? As it's currently stated in the glossary of the FATF, a virtual asset service provider is any natural or legal person who is not covered elsewhere under the recommendations of the FATF, and as a business conducts one or more of the activities that you see there on the screen, or operations for or on behalf of another natural or legal person. Again, as with the definition of virtual asset, the definition of VASP should also be read broadly. The FATF expects countries to take a kind of functional approach and apply concepts that we're going to touch on in a second, underlying this definition to determine whether an entity is undertaking the functions of a VASP or not. Also, as we discussed for the virtual asset definition, to avoid repetition or overlap, the definition of VASP only applies to entities that are not covered elsewhere in the FATF standards. For instance, it excludes financial institutions or designated non-financial businesses and professions that are covered or captured elsewhere by the FATF standard. Let me just point here to the phrase "as a business," which is meant to exclude those who make a function on a very infrequent basis for non-commercial reasons from coverage as VASP. To satisfy this portion of a definition, the entity must carry out this function for and on behalf of another natural or legal person, as opposed to on behalf of itself, for commercial reasons, and must do so on at least a sufficiently regular basis rather than infrequently. Let's go to the next slide, Brooke, so we can touch on what the main obligations that the FATF has established for VASP. And I think it's important to note that the FATF standard establishes obligations not only for the private sector, not only for VASP, but also for jurisdictions as well. In accordance with the standards, jurisdictions, countries are mandated to basically identify and assess the money laundering and the terrorist financing risks that emerge from virtual asset activities and the activities or operations of VASPs. They're also expected to require VASPs to be licensed or registered. They're expected to take action to identify natural or legal persons that carry out the VASP activity, and particularly those that are doing it without having registered or having obtained a license, and to apply sanctions to those that are operating in an unlicensed manner. Countries are also expected to monitor and to supervise and persuasive sanctions to those that don't comply with the regulations. But with respect to VASPs in particular, and there is a range of preventive measures that the global standard has imposed on them, which is pretty similar to the recommendations that are applicable to financial institutions and to those designated non-financial businesses and professions. In particular, the obligation to conduct a risk assessment and to apply a risk-based approach, the obligations to conduct customer due diligence and enhance due diligence measures. And just to note here to say that the occasional transactions, for instance, designated threshold above which VASPs are required to conduct customer due diligence is $1,000 or 1,000 euros. So for transactions from 1,000 and above. There is also an obligation to conduct record keeping on fund transfers and also to apply the travel rule, which we'll see in the next slides. And finally, my favorite obligation, because I'm a former head of a financial intelligence unit, the obligation to report suspicious transactions to the financial intelligence units of the country. These are the main obligations that stem from the international standards that are expected to be applied by VASPs. Turn to the travel rule now. So as we noted previously, complying with the travel rule is one of the main obligations for VASPs under global standards. And this includes the obligation to obtain, hold, and submit required originator and beneficiary information associated with virtual asset transfers. This is in order to identify and to report suspicious transactions, take freezing actions, and also to prohibit transactions with designated persons or entities, for instance, sanctioned individuals or entities. This requirement applies receive virtual asset transfers on behalf of a customer. Now, as you can see on the screen, the originating VASP must obtain and hold the required and accurate originator information on virtual asset transfers, submit this information to the beneficiary VASP or the financial institution, if any, immediately and securely, and make it available on request to appropriate authorities. And there are also obligations for the beneficiary VASP that must obtain and hold required originator information and required and accurate beneficiary information on the virtual asset transfers and make it available on request to appropriate authorities. So there are other requirements that also applied, including monitoring of the availability of information and taking freezing actions and prohibiting transactions with designated persons and entities, and the same obligations apply to financial institutions, as we said, when sending or receiving virtual assets on behalf of a customer. Now, to finish up here, let's just look at how this is being implemented. We go to the next slide. So just to say, the international community has been assessing through the FATF the level of implementation of the standards related with virtual assets and VASPs. The results of these assessments are typically laid out in the FATF's 12-month review of implementation. There's been 3 of them conducted. The last one was published in June of 2022. And this last report finds that many jurisdictions, many countries, and the VASP sectors have been making progress while 29 out of 98 responding jurisdictions have reported having passed travel rule legislation, only 11 jurisdictions have started enforcement and supervisory measures. 36 of 98 have not even begun the process of introducing the relevant legislation. So there has not really yet been a sufficient advancement in the global implementation of the travel rule, and the lack of regulation or the lack of enforcement of regulation is really allowing for digital arbitrage and increasing the money laundering and financing risk. So the fact is that you're looking at this very closely, expecting countries to make progress in implementing these obligations.
Terrific. Thanks so much, Mariano. That is an excellent overview of the international standards and the sort of current state of brief couple of notes on the U.S. Context in particular. So, like all other FATF members and regional members of FATF, the United States is subject to these international standards with respect to VASPs. And in the US, VASPs are generally considered to be engaged in money transmission services, which are defined as the acceptance of currency, funds, or other value that substitutes for currency from one person, and the transmission of this value to another location or person by any means. So under this definition, VASPs in the United States are required to register as MSBs with the Department of Treasury and to comply with any applicable state-level licensing requirements. They're subject to the Bank Secrecy Act and required to maintain an effective written AML program and comply with all the record-keeping, reporting, and transaction monitoring obligations under the BSA. So this is probably familiar to some working in this space, but if we could just briefly go to the next slide, I wanted to flag some evolution of the US framework for entities that may currently classify as MSBs for engaging in money transmission of digital assets. So regulators and lawmakers are currently discussing the appropriate regulatory classification of a range of different digital assets, and the outcome of these discussions could bring certain assets under the jurisdiction of the SEC or the CFTC. So just last week, the SEC Chair Gary Gensler signaled that he'd support a move to grant more authority to the CFTC to oversee cryptocurrencies such as Bitcoin. And previous statements under the previous chair, the SEC has signaled that Bitcoin and Ether may both be considered commodities under the CFTC's jurisdiction. This is also a sort of classification that could be codified in legislation that's currently in committee in the Senate. So the upshot of all of this discussion about is an asset a security, is it a commodity, is it something else, is that classifying particular virtual assets as securities or commodities could require VASPs that are currently regulated as MSBs to register with and be regulated and examined by one of these other authorities, the SEC or the CFTC. And the FinCEN director has sort of reiterated in a statement a few years ago that even if an introducing broker or futures commission merchant, broker dealer, or mutual fund that would fall under the umbrella of one of these other agencies, even if one of those entities is acting as an exchanger of digital assets and provides money transmission services for the purposes of the Bank Secrecy Act, it would not qualify as a money transmitter or any other category of MSB, and so wouldn't be subject to the BSA requirements that are applicable just to MSBs, but would rather be subject to regulations applicable to those other entity types, the introducing brokers, future commissions, merchants, broker dealers, and so on. So it's a somewhat technical point, but it could have important consequences for the registration and compliance obligations for VASPs that are currently seen as MSBs under the existing regulatory regime. So this is a development we're monitoring closely and want to track for the various VASPs that we're working with. So the slide right after this, if we want to just touch on that quickly, flags a number of issues that we won't have time to get into, but that we could just briefly touch on that look at regulatory issues that go beyond VASP. So in the conversation today, we've really been focused on international standard setting for VASP to address those various threats and vulnerabilities that we outlined earlier, and the obligations of VASPs worldwide, and then specifically in the United States. But there are a number of challenges that we've just sort of flagged here in bullets with respect to decentralized exchanges that may not qualify as money transmitters in the United States or as VASPs under global standards. NFT marketplaces, self-hosted wallets that allow peer-to-peer transactions without interaction with virtual asset service providers or other intermediaries. And then the important case of mixers that have come to light in the recent designation of Tornado Cash and associated wallet addresses. So these are a cluster of important risk management and regulatory challenges that we wanted to just sort of flag for the group. And perhaps we can just get into one sort of slice of these issues in our final polling question. So this question, we haven't had much time to discuss this, but I think we can see what the group's sense of this issue is as we close out. So one issue that for entities that are not VASPs is that if they are U.S. persons, they still are subject to U.S. sanctions obligations. So all U.S. persons are subject to U.S. sanctions compliance obligations. And so how do you manage the risks that are sanctions risks if you're not collecting know your customer information? And so the choices here are geolocation and IP blocking, detection of VPN and proxy use, blockchain tracing for connections to mixers and designated wallet addresses, or all of the above. So just in our last minute, if you could provide responses to this question, and then we'll sort of discuss the answer and close out. Okay. Well, this was almost everyone got the right answer here, which is all of the above. So this is it's a sort of all hands on deck, all methods approach to managing sanctions risk on the blockchain without customer information. The customer information would obviously allow you to do name screening against those name lists published by OFAC and other global sanctions authorities. But these are various methods that could be kind of critical for mitigating the sanctions risk. And in fact, in the June 2020 targeted update from the FATF that Mariano mentioned earlier, FATF highlighted that geo IP monitoring and blocking and pattern analysis using blockchain analytic tools are among the tools the industry should consider implementing to assist in sanction screening for virtual asset transactions. So that's an interesting space that should be a great topic for another webinar, another conversation, another day. But I'll turn it back to my colleagues if they had any concluding remarks or takeaways as we close out today's session.
For me, no, it is a great, really interesting session. I think, for folks just to keep in mind, we're bringing, well, the question is how much and in what way do you bring those entities into the regulatory perimeter so that their obligations mimic some of the TradFi or traditional finance institutions, and in what way is that good, reasonable, or not? And I think that that's going to be reflected in the conversations to come.
Likewise, nothing more to add, Alex. I think as we see the space maturing, developing, growing, we also see a promising development in the fight against digital asset related crime, with the growing ability of law enforcement to detect and to seize illicit obtained digital assets. And I think it's important to the importance of public collaboration, public partnerships, to ensure that users can transact safely and criminals can't abuse these new assets, and that's to the benefit not only of law enforcement and its goals, but also to the growth and expansion of the space of the industry as well. Thank you.
Perfect. Thank you so much to everyone for joining and participating in our polling questions and Q&A. It's been a pleasure, and I hope to see you again sometime soon here.